Assalamu alaikum. Welcome to AFM lecture 13. This is the smallest topic, okay, which is regulation of takeovers. We don't have any questions, and this is not a calculation. This is from a point of discussion question, okay. You will be asked something from this if you are given an acquisition and a merger question. Earlier, in my earlier two lectures, I went through what are the synergies, types of synergies, then how do you value an accusation. Now, why regulation is important for takeovers. Okay, see, when a question on accusation and merger is given, okay, they will give all the aspect of it will be asked in the exam. It's just not calculation, it's just not valuation. No, they will ask the valuation, they will ask the defense mechanism which comes under this lecture, regulation. Then they will ask how do you finance the accusation. That will be my next lecture. Okay, the last lecture under accusation and merger will be my next lecture, that is how do you finance takeovers. Then also they will ask synergy benefits, so you have to, all in all the four lectures will be asked. Okay, it's like bits and pieces from each lecture they will ask you. They will not entirely focus on just valuation or one lecture, no. So starting with this, here we are going to go through two things only. One, the regulation of takeovers, why it is regulated and all. Next, the defense mechanisms that the management of the target company uses, especially when the takeover is hostile. Okay, they do not want a company to come and take them over, right? They definitely want to stop it from happening. They want to defend themselves. So there are some mechanisms that they do. Okay. This the second question, especially the second point, defense mechanism is a very popular topic. It has been asked in the past paper. You can see lots of revision kit questions on this area. So that shows examiner is very likely to test that area, right? You have to write about it. So starting with regulation of takeovers. Before we are going to the defense mechanism, we first need to understand the general principles of takeover regulation. Why it is so regulated? What is the important idea? These are the few areas. See, in your exam, they will not ask you why these things. But knowing this is helpful for you, especially when you are in the real life, when you are in the working area. If you are like in this area where you have to value an accusation, this things will be very helpful for you. Okay, so it's very easy, nothing long. Very briefly, we'll go through it. Number one reason is for the company's life, this is very important. At the most important time in the company's life, what is the important time when the company is subject to takeover bid? Okay, at some point, okay, either you are taking over someone, either you are being taken over someone. The a point comes, right? So in that condition, director should act in the best interest of the company for the shareholder, not their personal interest. That's why this is highly regulated. If imagine if the takeover was not regulated, anyone can just come and take over and do whatever they want. The government says no, you just cannot take over. There are some rules, some principles, some ethics you need to follow when you're taking over. You have to take care of your shareholders' interest. If you think that taking over is in the interest of the shareholder, go ahead, otherwise stop. Second, all shareholders must be treated equally, whether it is the target company shareholder, minority shareholder, majority share, all are treated equally. That is the reason why it is regulated. Third, shareholder must be given all the relevant information to make informed judgment. Remember, because see, it is the managers of the company who know all this information. They decide that that takeover is good or takeover will be bad. They come and they inform to the shareholders, but shareholder has to be given all the relevant information based on which they can make their own judgment. Then board. The board must not take action without the approval of shareholder when it comes to acquisition merger. Right? All information supplied to shareholder has to be given with the highest standard of care and accuracy. Okay. And regarding assumptions on which profit forecast are based, okay, all accounting policies should be diligently checked by the accountants or the auditors. And for valuation of assets, you need an independent valuer. An independent valuer should come and value this. So the regulated, this is how takeover regulation helps you. In short, they are protecting the right of shareholders, all shareholders. They are giving them equal treatment, right? Now, moving on to shareholder and stakeholder models of regulation. See, there are two models. This you might be asked, you might not be asked in the exam. Okay, we cannot tell. But you have to know what these two models are. Shareholder means we know protect right of shareholders. Stakeholder means protect the stakeholders and all the type of stakeholders. You know what are the stakeholders, right? Customer, supplier, lender, all those things. So, which model is better in this two? If a question is asked shareholder or stakeholder, it varies. Why? If you are looking at it from the point of agency problem, stakeholder is better because stakeholder solves the issue. They take care of all the stakeholders. Understanding? So that is more successful at dealing with agency problem. And if you can see that some managers are abusing their power, stakeholder model is better. But shareholder model is more efficient. It is economically efficient because it is easier to look after one stakeholder, that is shareholder, rather than taking care of all the stakeholders. Because obviously some will be unhappy, some will be happy. It's hard to balance. But for shareholder, you don't have to balance it. You just look after one person, that is shareholder. And they also have one goal. Shareholder has one goal, that is their wealth maximization. Coming to stakeholder, each stakeholder has different needs. How can you manage all? Right? So it is economically not efficient. Synergy is often gained through redundancies in an acquired firm. Remember, when redundancies are made, it will lead to synergy. Why? You are saving on the cost. Rather than duplicating work, make redundant. Okay? So synergy is gained. But this is an unethical practice. Many of them might think this is an unethical practice. Why? Because some are laid off. So in this case, stakeholder model is likely to give emphasis to employee protection. If you are using stakeholder model, you are going to protect the employee. So in the exam, they can give you anything. They can give you this as a discussion question, which model is better in this, some scenario they will give you, or they might say, you know, at least you know what these two models are. So answer varies. Now we are moving on to some three specific examples of takeover regulation. Number one is the principle of equal treatment. It says all shareholder must be offered the same terms. Okay. Whether you're a majority shareholder, whether you're the minority shareholder, same terms will be offered. There is no less or more favorable. Okay. The objective is minority shareholder has to be protected. That means they're also getting the same level of benefit as the majority shareholder. You understand? Coming to the next, it is known as squeeze out right. You have to know these terms, by the way. In the exam, you have to make use of these terms. Equal treatment of shareholders, squeeze out right. What is squeeze out right? The meaning of squeeze out, you're squeezing out, forcing it out from someone. What is it? You are forcing the minority shareholders to sell their stakes. Let's say, and this does not happen at low percentage. For example, you are purchasing a company at 90%. That means minority shareholders are 10%. What do you want? Force that remaining 10% also to sell their shares to you, so that you become the complete owner. That means you have acquired 100%. Right? Why is this? What is the benefit? The benefit is, see, later on issues might come. It will come among the majority and the minority. So rather than having that issue later on, why not you get the 100% and then there'll be no issue. There'll be no problem between you and the minority shareholder. So to prevent that problem, squeeze out. Third, it is known as mandatory bid condition through sell out rights. What is the meaning of this? You allow the remaining shareholders to exit the company at a fair price. At a fair price. There will be some shareholders after you have taken over. Tell them to exit the company, but at a fair price. Once the bidder has accumulated a certain number of shares. Okay. Remember, how much of shares you have to accumulate before this rule. That means before getting the exiting at fair price, it depends. It varies between countries. Okay. Each country will have different number to that you don't have to worry. See, whenever they are giving you regulation of takeovers, every country has different regulation. You don't have to worry. They will not ask you for a specific country. Okay. So the bidder must offer the shares at the highest share price as a minimum, which had been paid by the bidder previously. So basically there will be no numerical questions, no calculation question on this, only write it. Now, the objective is what? So that acquirer does not exploit his position of power at the expense of minority shareholder. You understand? Even the minority shareholders are exiting the company, but they're getting a fair price. Now, coming to the our very popular topic, that is defenses. There are two types of defense. One is pre-bid, that means before the bid. The other one is post-bid, after the bid. For pre-bid, there are defenses like poison pill. These are the terms that I use. Use this in your answer. Poison pill. We'll go in detail to each one of this, what it means. Second is change the article of association. Second category is post-bid. This is after the bidding has taken place, you defend. Like appeal to your own shareholders, white knight, counter bid Pac-Man, and refer the bid to the competition authorities. You might be confused. You might be thinking, what is this white knight Pac-Man? Don't worry. I'll explain you. So starting with poison pill. What is the meaning of poison pill? What is the reason why the target company is a target for a takeover? Maybe you have some assets, something was there which made you very attractive, right? So now what do? You take steps to reduce that attractiveness. You try to make yourself less attractive to your bidder. In that way, the bidder itself will stop the accusation from going ahead. The most common method are like what? You can tell your existing shareholders to buy shares, right? Or buy future bond or preference share. So if a bid is made before the date of exercise of this right, then the rights will automatically be converted into full ordinary shares. Okay, basically you can sell your shares, sell your assets. Maybe you have attractive assets, maybe you have a valuable asset that is there, sell it off, or sell the shares to the existing shareholders. So in that case, you are making yourself less attractive. Next is change the article of association. Let's say now you require, by changing it, you are saying you require a higher percentage of shareholders to vote for the takeover. Okay, so this is easier. Why? Because shareholders, normally not all shareholders might vote for the takeover. So if majority of they are not voting for the takeover, automatically takeover will stop. Moving to the post bid defense. Most of the time it is the post bid defense that is asked in the exam. They are more concerned on this area. You can appeal to their own shareholders. What is the meaning of this? For example, by declaring the value placed on the target company's share is too low in relation to the real value and earning power of the company's assets, or you are saying that the market price of the bidder share is unjustifiably high and it is not sustainable. What are you doing? You go and appeal to your own shareholders by saying that your actual value is very low. Compared to what bidder have valued your company, your actual value is low. So you are making yourself less attractive to the bidder. You are saying your value is low. Because if your value is low, obviously the acquirer might not want to acquire you. Okay. Second, so there are some well-managed defensive campaign under this. Number one, you can do is aggressive publicity on behalf of the company. Okay. That means why your company is not good, why it should not be taken over. You can do it. Second, directly you communicate with the shareholders saying that because of some financial or strategic reasons, it is better not to merge, not to acquire each other. Better to remain independent. Next is white knight strategy. What is the meaning of white knight strategy? You are calling another company to take you over. This is like you are calling a friend to add. This is a temporary. You are calling them to add that they are taking you over. Rather than being taken over someone unknown, hostile takeover, it is better a friendly takeover takes place, right? It's like you are calling a friend to rescue you out of the situation. Okay, but remember, this tactic should be used as a last resort. Okay, because you you ultimately are going to lose your independence, whether it is a friendly takeover or hostile takeover. Even if it's a friend that is coming to rescue you, saying that they are going to take you over, Still they're going to take you over and you're going to lose your independence. So use it as a last resort. Then we have counter bid. Rather than letting yourself being taken over by the bidding company, you do a counter attack. You say you are going to take over the bidding company now. Understanding? So now the bidding company is subject to a takeover. Rather than you being eaten over, you go and eat them. You see that Pac-Man, there's a game. They come and eat all those dots. So that's the same thing you do. Counter attack. Competition authorities, you can call for government intervention. How? By bringing this issue in the eyes of competition authority. Okay? And remember, this will prove effective. That means they themselves will stop this accusation only if you can prove that this takeover is against public interest. If it is proven, you are saved. Okay? So that's it for this lecture. So in this lecture, we started with regulation of takeovers. We went through the three things, that is principle of equal treatment. They have to be given favorable terms, all equal terms. Second, squeeze out right by telling them to sell out their shares, the remaining shares. Okay. Mandatory bid. You are telling them to exit the company, but they are going to receive a fair price for it, the minority shareholders. Then we went through defense against takeover, pre-bid and post-bid. Pre-bids are poison pill. You make yourself less attractive by selling out your assets or selling your shares to the existing shareholders. Give right issues. Change the articles of association by saying that now you require a major proportion of shareholders saying that they have to vote for the takeover. Otherwise, takeover will not take place. Post-bid defenses are appeal to their own shareholders. White knight. White knight means you are calling a friend for a rescue. That means another company is going to take you over. You announce it. Counter bid, where you make a counter offer to attack to take over your bidder and refer the bid to the competition authorities, where you have to prove that this takeover is against public interest. So that's it for this lecture. But make sure it's your job now to find questions on this defense mechanism from revision kit and do it. Thanks for watching and see you in the last lecture, that is lecture 14, under acquisition and merger. That is how you are going to finance acquisition and merger. A question that is 100% you are going to get if you get acquisition and merger. There is no doubt. In fact, all are important, but that is very important because majority of your calculations and all is in that financing part. So after this, we'll be moving on to our new section, that is reconstruction and reorganization. So see you in lecture 14. And thank you for watching, and don't forget to subscribe to my channel.